Welcome back to another weekly market and financial update. We took last week off because I was away, and now that I'm back, we're here to talk about the markets and where they're moving. So, the markets right now are basically sitting at an all time high, which is very impressive despite everything that's happened over the last couple of years. We've dealt with COVID, we've dealt with sticky inflation, and yet the US economy has proved to be extremely resilient to all of these different factors. Now, knowing this and knowing that the markets are at an all-time high, the market can really go one of two places, right? They can either continue to go up or it can go down. Or, of course, it could, as a third option, stay relatively flat. But markets tend to either go up or down versus staying flat at any given point looking at historical data. So we know the election is coming up, and I've talked about it over the last few weeks to expect some volatility during that time period. Markets don't like uncertainty whatsoever. Markets can handle good news, they can handle bad news, but they can't handle uncertainty. They just don't like it. They don't know what to expect whenever there's a big question mark about what's coming up over the next 3 to 6 months. So, with that in mind as well, let's talk a little bit about the Fed because that's really where all the headlines are. The Fed's meeting is coming up in a few weeks on September 8th. So most folks now are anticipating the Fed reducing rates. Even the Fed has strongly hinted, Jerome Powell has strongly hinted at the fact that they are likely to reduce rates during their September 18th meeting. Now, by how much is another question altogether. I personally believe it will just be a 25 basis points rate cut. Some folks I think might be hoping for a 50 basis points rate cut, but just knowing that the Fed has been so flat, they've had one of the longest rate pauses in US history. I think that they will just do a slight adjustment of 25 basis points. The last thing the Fed wants to incur or really deal with is repeating the cycle of overinflation all over again. So they're going to be very cautious in the decision that they make, especially when it comes to lowering rates. They don't want to lower rates too quickly and ramp up the economy so much that it just overheats and we're back in high inflation and dealing with the same problem we've been dealing with the last 24 months or so. So that's why I personally believe that they'll just go down 25 basis points, but it's still good news. The market has priced in this good news already, and that's really why the markets are at an all-time high. So in terms of just knowing where rates are and what can you do to anticipate some of these rate cuts that are coming out, I mean, the Fed even said there might be a chance that they lower it a second time at the tail end of the year, maybe in December. I personally think that's a little unlikely, probably more likely early 2025, maybe January or February, but we'll see. But what can you do as an individual investor to manage your portfolio during a period of rate cuts? Well, cash has been a very, very strong option for most folks, including myself. I've loved the fact that I can go to basically any bank down the block and open a savings account or a CD, whether it's 3, 6, 9 months, doesn't matter, right? But basically, you can open any one of these accounts for about 5%. And it's been a wonderful way to stock money away, especially during volatile markets or maybe some short-term goals that you don't want to put your money at risk, because 5% for maybe a period of 3 or 6 months, knowing you might spend it for a future project on some home renovations or whatever, is really, really nice. So as these rates start to fall, cash will become a less attractive option, and this opens up some opportunities for each and every one of us to reevaluate our portfolios. I've talked over the last few weeks about fixed income. I think fixed income is a very attractive option right now for a lot of young investors. I recently saw a finance article come out and said that why young investors or younger investors shouldn't concentrate in fixed income. And that headline to me was a little bit misleading. I think having good diversification in a portfolio is really important. And even if it's a small allocation, 10%, 15% of fixed income, it can still be a nice option just to balance out your portfolio altogether. If you're someone that's nearing retirement or in retirement, or maybe you're in the middle of your career and you have a larger concentration of fixed income, maybe 30, 40, 50, 60%, whatever that number might be, now is a great time to reevaluate what fixed income positions you own, knowing their yields to maturity, knowing their duration, all of those different statistics behind those fixed income figures. And if you're not sure what I just talked about, what those numbers mean, what those statistics mean, then you're always welcome to reach out to us. Myself or any one of us on our team is more than happy to explain it to you. Again, fixed income, I think, is a commonly misunderstood investment, but it can be a really, really valuable investment, especially in a period of rate cuts. As rates fall, the value of fixed income will rise. So we're in a sort of unusual period of time. This doesn't happen too often, where fixed income yields are really nice. I mean, you can find investment grade corporate bonds between 3 to 5 years to maturity, yielding around 6%, 6.5%. It's pretty common to still find that. And if you're owning one of those bonds and it's not callable, or it has call protections built in for a certain period of time, to be able to lock in a rate at 6.5% with some nice potential for capital appreciation is really powerful, especially from fixed income. So any questions on this? Again, I'm not necessarily advocating that everyone specifically should rush to the store and go buy some fixed income. I'm just saying that in this interest rate environment, it prevents a nice opportunity just to reevaluate your existing investments and see what you can do to try to reposition where you are. And if it makes sense, great. And if it doesn't make sense, great, right? It's very, very important to consider your individual circumstances and understand that your portfolio and your goals are going to be very different than my portfolio and my goals, your neighbor's portfolio down the street, your aunts, your uncles, grandma, grandpa, right? Everyone's goals are unique and individual. So if you're just thinking about, hey, what can I do with my portfolio? I think now is a very opportunistic time. I think opportunities present themselves more in times of uncertainty and volatile markets versus in times of strong markets and pretty consistent rates of return, because then the path is relatively clear, right? Just own some stock and it's going to appreciate because the markets are doing well. But when the markets aren't doing so well, or when we're not sure what the markets are going to be doing, it provides a lot of wonderful opportunities for us as individual investors to make good decisions as long as they are in line with our goals and what we're looking to accomplish. So again, a lot to talk about in the coming weeks. We'll keep an eye on what the Fed does. Their decision will be very, very impactful on the precedent they're going to set for the remainder of the year and early into 2025. And I hope everyone has enjoyed the rest of their summer. We're coming to the unofficial end of summer with Labor Day coming up. So again, hope everyone had a wonderful and safe summer with their families and loved ones. And I look forward to speaking to everyone next week.